Good morning from our global headquarters in New York. I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda. Getting cautious, the latest hedge fund filings show investor titans moving into cash and away from U.S. tech. A crypto hack, Coinbase moves to contain the fallout after a major breach of its customer data. And consumer resilience, Richemont sales jump in Europe, and we'll get a read on the U.S. with the UMich survey out later today. 4 consecutive days of gains. Can we make it 5? It is an equity market that is attempting to do just that in the future session so far this morning, up nearly 0.3% for your S&P 500 futures. We outperform on the NASDAQ. We are up now nearly 19% since the lows in April. You also had some easing in the pain of the bond market yesterday. You had easier PPI data. Oil came off the boil with hopes of an Iran and U.S. nuclear deal. All of that leading into, are we pricing in something of a soft landing again? Maybe more cuts because things and inflation look more benign. We continue to rally in the bond market this morning. We're at 3.9, back under 4% for your 2-year yield. Your 10-year yield stands at 4.4. We were at 4.45 at this time yesterday morning. So definitely a more benign yield environment. Let's look underneath the hood now and get some stocks that are moving in the pre-market session. With that is Bloomberg's Joe Easton. Good morning, Joe.
Morning, Danny. So Applied Materials, really the weak spot this morning, sliding following a miss on its bookings numbers in terms of the US. Its biggest machinery chip company listed in the US markets. We're down around 6% for that one, a tepid forecast from Applied Materials today. Then Take-Two over in video games. Again, it looks like weakness on the bookings for the year ahead, missing some analyst expectations by around $1 billion. And we're all still waiting for Grand Theft Auto 6. Probably won't see me for about a week when that game comes out. We've been waiting around 10 years for that game, and it's not helping that stock this morning. We're down almost 4% for that one. Then finally, Nvidia, Michael Berry up to his old tricks again, taking out some put options on that stock before the stock fell. It's therefore doing pretty well, according to some 13F filings released yesterday. Let's hope he got out of that trade before the stock recovered. But Michael Berry of Big Short fame doing well. Nvidia, though, edging out very slightly in the pre-market. And as usual, take a look at the before the bell opening wrap for a wrap-up of all these stories. So, Joe, if you disappear for a few weeks, we'll know where you went if it coincides with that release. Joe, thank you so much. I'll be completely AWOL. I love the honesty. Joe, we'll catch up with you later this hour. Bloomberg's Joe Easton there. And in just moments, Michael Sneyd of BNP Paribas will be joining us. Later this hour, Jose Torres of Interactive Brokers. Now, the team over at BNP Paribas weighing in on the recent stock rally, writing, quote, "It is notable that positioning in the U.S. and European equities remains relatively light, suggesting that participation in the recent equity recovery has been muted. Expect this to result in support for dips." Joining us now is Michael Sneyd, head of cross-asset and macro quant strategy at BNP Paribas. Michael, great to see you this morning. And it's been a remarkable recovery. I mentioned we're up nearly 19% for the lows. If participation has been low in that, what's been driving it? And what does that say about how much juice is left in the rally?
Hi, good morning to you. Thanks for having me on. Incredible rally this week. Really off the back of the news flow really at the start of the week, reducing some of the tail risks, both the upside tail risk to inflation and some of those downside tail risks to growth. So, for example, we have increased our likelihoods that we'll have a kind of our base case outlook this year that there won't be a recession in the US. We've increased that likelihood from 60% to 70%. When we think about the equity market rally, as you mentioned, Danny, the participation looks like it's been kind of reasonably low. And what I mean by that is, on the quant side, we run positioning metrics that try to identify how are investors at the moment positioned across different markets. And we saw that investors pulled back on a lot of their positioning early April with the market turmoil. As we've had the stock market rally, you haven't had investors really aggressively add positions. They have increased positions, but overall positioning is still much lower than it was in equities, than it was at the beginning of the year, particularly in US and Europe. So the price move has been largely driven off the kind of change of the economic outlook. And going forward, what this suggests is that there could be some more flows to go into equities. But I think it's quite a challenging backdrop for equity investors. You've now had this dramatic rally. You probably could get some buy on dips if you were to see a dip in equities. The other question I think that a lot of investors are asking is what about diversification? Because when you look at how equities have been forming versus bond markets, you've not been getting that diversification. You didn't get it during the market turmoil earlier in April. And so a lot of discussions we're having with clients is, how can you provide some diversification?
Well, Michael, on the point of the volatility, and I'm sure this is something you closely track, it may be difficult to answer because every model has different time horizons. But when you get these types of spats of volatility, surely you have more systematic type strategies that pull back from equity because of that volatility coming in. If that is the case and we're starting to normalize, how long does it take to see some of these types of investors to dip their toes back into the market?
So it can normally take a couple of months. So as that vol comes down, it then feeds into the algorithms of how much risk can be put back on. And this is actually one of the kind of factors that could continue to support equities from here. As although the prices have rallied, if you look at, say, the way that CTAs are likely to position going forward, they're still likely to be buyers of equities.
Michael, you also put in your notes that some of the data surprises have turned negative. And this comes after a period where the data really has not started to reflect the tariffs. And we're just getting a slight view into that now. CPI from this week, you could argue, started to show the beginning phases of tariff effective data. If that's just starting to creep in, do we have a problem? Do we have a problem of equity markets just starting to rally as the data, hard data, might soon start to reflect the consequences of tariffs?
Yeah, I think this is a theme that could really kind of disturb the kind of more positive status quo that we've had this week. So if we think about the economic outlook to the end of the year, that's certainly looking more positive this week, as I mentioned, with kind of the change of the probabilities for our base case. But if we think about the path over the coming months, we will likely have this very mixed data flow. And really what's key here is some of the kind of the lags of the information flow that the market receives. So the data that we'll be having now, as you saw kind of with the retail sales yesterday, is going to be reflecting some of the uncertainty that we had back in April. We also see on our measures, the relationship that it tends to take for the time that you get a shock to financial conditions to feed through to data can be up to 3 months. So actually there's an argument from a kind of a data science and evidence perspective that actually the softness of data that we're seeing right now is more because of the tightening of financial conditions that took place more in February, March than in April. So that suggests that we could continue to get some more headwinds to economic data coming up over the coming months, which then makes thinking about the outlook for this year a bit more challenging.
Okay, so tell me why you're adding to long duration positions then, Michael, because this has been a tricky one with 30-year yields bumping up around 5%, easing off of that. What's your take there?
So here there's really kind of two opposing dynamics. So in the short term, this negative data surprise trend that we're having, expectations that you could get data weakening in the short term because of the headwind of financial conditions, that we see as being positive for duration. On the other hand, if we think about the other kind of key theme that investors are likely now to turn to, now that tariffs are going to be kind of less of the kind of headlines driving the markets, we have the fiscal situation in the US and the upcoming discussions around the new fiscal bill. And here what's really going to be important for the market and important for the bond market is the extent to which the US government is being seen as being kind of bond vigilant, that they're conscious that they don't want to allow the term premium to rise, they don't want to be seeing as being kind of too loose on the fiscal front. If you do continue to get signs that the administration is bond vigilant, which we think they are, then that will allow kind of term premium to compress, and that can be supportive for fixed income in the US.
No, Michael, just quickly, is it really about the level or the pace? Because even though bond yields have been moving up, it's been an orderly type of sell-off. Is that really enough to try to bully the administration and and Congress to being more prudent when it comes to fiscal policy and deficits?
I think when it comes to administration, the pace is kind of important around their kind of responsiveness. I think the level is important in terms of the kind of projection that the CBO has for fiscal costs, so therefore feeds back to the administration. And I think also what's key in terms of level is investors looking at fixed income and seeing that there's good value. Our short-term valuation metrics do show that there is value in fixed income at the moment. But just looking at the levels historically, the yields that you're getting on 10-year, 30-year bonds are also looking relatively attractive.
All right, Michael, thanks so much for joining us this morning. Enjoy the rest of your Friday and your weekend. Michael Sneyd of BNP Paribas. All right, let's get you some other top stories that are trending on the terminal this morning. Michael Burry was buying puts on Nvidia and Chinese tech stocks in the first quarter, right before President Trump rolled out his Liberation Day tariffs. The latest filings show that Burry's Scion Asset Management liquidated almost its entire equity portfolio in the first quarter before taking the bearish wagers. And Coinbase said Thursday that it refused to pay hackers a $20 million ransom. The U.S. crypto exchange said that cybercriminals bribed its customer support agents to gain nearly constant access to sensitive user data, which includes names and birthdays, since January. The hack is expected to cost Coinbase $400 million. And Richemont posted a rise in full-year sales thanks to the popularity of the jewelry division's Cartier brand. The Swiss luxury group was more resilient than its luxury rivals. Richemont shares are up 20% this year, while LVMH has declined nearly 19%. Coming up, President Trump wraps up his Middle East trip in Abu Dhabi. We'll have more on that coming up next on your Bloomberg Brief.
We have, at the same time, 150 countries that want to make a deal, but you're not able to see that many countries. So at a certain point over the next 2 to 3 weeks, I think Scott and Howard will be sending letters out, essentially telling people, it would be very fair, but we'll be telling people what they'll be paying to do business in the United States.
President Trump wrapping up his first overseas trip of his second term in the Middle East with a promise of incredible investment back into the U.S. Joining us now is Bloomberg's Brendan Murray. And Brendan, we heard there from the president as he starts to end his Middle East trip. What have been the takeaways of a very headline-heavy visit?
Yeah, well, the main takeaway is that the president spent the week in this region to try to get the flow of investment, of money, back to the U.S. for things like factories and advanced equipment investments that some of these countries have committed to doing. The UAE is building funding an aluminum production facility. The president said. So the main thrust of his goal this week was to get the flow of money back to the U.S. He spent the first 4 months of his presidency, his second term, trying to get trade flowing, trying to renegotiate trade deals. So that would be the main takeaway from the 5 days that he spent there.
If you also look at who's been accompanying Trump on this trip, Scott Bessent was also in the Middle East as well. And Trump said this just about an hour ago, that Bessent will be sending letters to countries, that Bessent to say what they have to do, what they have to pay to do business in the U.S. Brendan, is this Scott Bessent fully in control now of American trade policy?
That's what it sounds like from what we heard from the president today. I think the main takeaway from those comments about the 150 countries is that the U.S. administration is overwhelmed with the amount of trade negotiation that it needs to do. There are a number of talks going on bilaterally with India, with Japan, with South Korea, with China, and that as the president said, there are 150 countries that want to do deals, and there just isn't the capacity to handle that. So it sounds like a lot of those countries are going to get a letter saying this is what your tariff rate is. Now, he was vague on the details. He said this is what they're going to pay to do business, but it sounds like that those reciprocal tariffs that the president announced on April 2nd, some of those countries are going to get a letter saying this is what your number is.
Will they be willing, though, to accept frameworks akin to the UK, akin to China, Brendan? Because, for example, the FT reporting this morning that Japan appears to be holding out for a better trade deal.
Yeah, exactly. I think one of the things that's coming to light as the weeks progress is that 10% floor, that 10% reciprocal tariff rate floor, isn't going away, and a lot of countries want it to go away. South Korea wants it to go away. Japan does too. There are a number of countries that have free trade agreements with the U.S. that say, look, we've got zero tariffs now, and that's the rate we want. They're going to find out. It appears very quickly that rate is not going anywhere, and that will be the minimum number that every country is going to get.
Okay. Brendan, thank you very much. That is Bloomberg's Brendan Murray. By the way, President Trump also saying at one point that when Scott Bessent speaks, markets go up. It appears that he has been paying attention to the research over at Renaissance Macro and Neil Dutta, who ran exactly that study that when Bessent speaks versus Lutnick or Navarro, markets do indeed go up. So perhaps that's part of the reason why Trump has ceded a lot of the trade talks over to Bessent. Now, let's go over to Europe because officials are gathering in Albania as hopes fade for a Ukraine ceasefire. Bloomberg caught up with the deputy head of the Ukrainian presidential office. Take a listen.
I believe that without Zelensky, Trump and Putin, there is no way forward. The only way forward can be is that if Zelensky meets Putin, and that's what President of Ukraine declared a couple of days ago. His readiness is absolute, and he is available anytime to go to Turkey and any other place to meet with Putin to talk about the ceasefire first, and then about all other terms and conditions of the real lasting peace.
Let's bring in Bloomberg's Oliver Crook, who is there at the European Political Community meeting in Tirana, Albania. Oliver, just how far away are we from something of a ceasefire in Ukraine?
So it sounds from everybody we've spoken to, whether it's the Ukrainians and a number of the leaders that have just walked by here, and just to remind everybody what this is the European Political Community Summit. This brings together 47 leaders from around Europe. This is a very wide group of people. This includes the UK, the Nordics, as well as Turkey. And this is a sort of meeting that was set up in the wake of the Ukraine war, really to discuss issues of defense and European competitiveness, and has sort of been turbocharged by the Trump presidency, where Europe really begins to imagine itself as a continent alone. And really the sort of main focus today is going to be on Ukraine. Zelensky will be here, and really any kind of contact and the discussions that we have in Turkey today. We should say that this is the first sort of not really high level but mid-level talks, direct contact between Ukraine and Russia. That will happen today. We've got confirmation that those two groups will be meeting today. But when you talk to the leaders coming in here, there's really any kind of skepticism that Putin is being serious about making progress on these talks, getting towards a ceasefire. The question for European leaders really fundamentally has been really for a number of years now, what is it that they can actually do? They've really maxed out the sanctions at this point. There is not a sense that the Europeans can do a whole lot more, and everything will really basically reside with Donald Trump. Lindsey Graham was also in Turkey yesterday. He is the sponsor of a bill before the Senate that would bring out what he called bone-crushing new sanctions on Russian oil and gas. That would be the next step if the Europeans and Zelensky are able to convince Trump, which they have not been able to convince him of yet, that Putin is actually the impediment to peace here.
Well, it seems like there is a desire to have at some point a sit down between Trump and Putin themselves. Marco Rubio talking about it after a NATO meeting in Turkey. Trump saying something similar, that nothing's going to happen until he meets the Russian leader. Oliver, is that even on the calendar, a meeting between the Russian and the American leaders?
Listen, it's not on the calendar as of now, but they've been teasing it now for a number of months. You know, even really before he was inaugurated as president, the discussions about whether Putin and Trump will meet. And listen, you know, Trump had demonstrated some willingness to show up in Turkey on Thursday if Putin were to show up. We know that Zelensky was there. But again, this is all going to be down to basically the rhythm that Putin sets and the discussion that he sets out there, because he's not going to want to be seen to basically convening under Zelensky's initiative. And we should say that really the sort of tone from Zelensky has changed dramatically since that Oval Office visit. You see it every time. Basically, every time Trump says jump, Zelensky says how high. We're going to jump even further. We're going to be there for this talks. We're going to be there for the conversations. It has yet to yield a sort of a concrete result in terms of more progress and more sort of sympathy from the Trump administrations on the Ukrainians. But they're trying their absolute hardest, and they're going to be making some more progress on that minerals deal, which we're seeing as sort of the key next step in order to gain U.S. support and potentially security guarantees for Ukraine after a ceasefire.
Hey, Oliver, just quickly, because we do have a NATO meeting happening in June. I'm glad you got the umbrella there, starting to get rainy over there. You have a NATO meeting in June. What is the setup for it? What are members there trying to do in advance of Donald Trump and others coming?
Yeah, so listen, when you think about how Donald Trump is running foreign policy in the United States right now, it feels like everyone is basically auditioning for something, whether it's Zelensky, whether it's the EU on trade, and all the sort of different trade partners. And it feels very much that way for NATO, right? Everyone is still auditioning that NATO is still a sort of legitimate force that can really bring something to the table. So what we've got right now are side meetings from the defense ministers of NATO's, namely the European ones, discussing possibilities of a new sort of reinvigorated NATO, of what they can present to Donald Trump when he arrives in The Hague at the end of June. And what we've heard repeatedly from the President of the United States is that he wants to see 5% GDP spend, which, of course, is a huge sort of volume of spending. This is not the kind of spending we've seen out of Europe or really many countries in a very, very long time. So they're trying to find ways to basically fudge that a little bit, 3.5% on defense, maybe 1.5% on dual use. And those are the conversations happening right now in advance of that NATO meeting where Trump is expected to attend at the end of June.
All right, Oliver, we'll let you get indoors and get dry. Thank you so much for joining us. That is Bloomberg's Oliver Crook. Coming up, a major disruption expected in your commute this morning. If you are coming from New Jersey, the New Jersey Transit on the brink of a shutdown. We're going to have the details for you on the worker strike coming up next. Let's take a look at the front pages this morning. The New York Times reporting on the first statewide transit strike in New Jersey. In more than 40 years, tens of thousands of commuters are expected to be affected after more than 450 engineers walked off their job in a pay dispute just after midnight.
We are going to remain open to sit, discuss, negotiate, to do whatever we can to bring this to a positive outcome, which is, again, meeting both objectives: a fair deal for them, and a deal that does not blow up our fiscal reality.
Good luck on your commute this morning if that's affecting you. And the Journal leading with Meta postponing the rollout of its flagship AI model, Behemoth. Journal sources say that the delay has prompted internal concerns. Some engineers questioned whether the model has improved enough to justify public release. Coming up, we get back to the markets. This is Bloomberg. From our global headquarters in New York, welcome to Bloomberg Brief. I'm Danny Berger. Let's set your agenda. Getting cautious, the latest hedge fund filings show investor titans moving into cash and away from U.S. tech. A crypto hack, Coinbase moves to contain the fallout after a major breach of its customer data. And consumer resilience, Richemont sales jump in Europe. We'll get the latest read on the U.S. consumer with you, Mitch, on deck. 4 consecutive days of gains will today make it 5. S&P 500 futures moving 0.25% higher this morning. Same goes for the NASDAQ and Russell 2000. The latest leg in this rally coming from softer PPI and lower oil prices. And does that mean we'll get cuts that are cuts because of soft landing, not because of fears of recession? You see yields move lower this morning after moving lower yesterday. We're back below 4% on your 2-year yield. Your 10-year yield moves below 4.4% this morning. That's lower by about 3 basis points. So those are your overall markets. Let's get some stocks to watch. Back with us is Bloomberg's Joe Easton. Hey, Joe.
Hey, Danny. So Applied Materials really the big decliner in the tech market today. We're seeing that stock down more than 6% in the pre-market as the maker of semiconductor machinery, the biggest in the US, reports a miss on its bookings guidance for the year ahead and really hitting that stock this morning. Then we got Take-Two also declining in the video game space. A lot of focus on Grand Theft Auto and when the 6th version of that will eventually come out. 13 years we've all been waiting for that game to come out. As I said earlier, you won't see me for a very long time when it does eventually get released. But that stock down 3.8% in the pre-market following that update. Then over in a bit of a niche sector, it is space tourism. We're seeing Virgin Galactic soaring. Take a look at this one. We're up 20% in the pre-market. Richard Branson founded a company saying last night that it's going to increase the price of its trips to space for space tourists, already charging around $600,000 per trip. I thought my recent holiday was expensive, but that is pushing it a little bit. We're seeing that stock, though, gaining. The company beating on expectations in their latest quarterly earnings report. Down in the small caps, but a big gain at around 20% in the pre-market this morning, Danny.
Yeah, well, luckily, I don't think the Fed is too concerned about space tourism inflation. So So at least that's one we can rest easy about. Joe, thank you so much. That is Bloomberg's Joe Easton. Enjoy the rest of your weekend. All right, President Trump's Middle East trip is coming to a close. Jose Torres of Interactive Brokers weighing in on the trade momentum in the talk, saying the dynamic signals a bullish landscape where the focus is shifting in forcing to re-accelerating economic growth on the back of robust capital expenditures, lighter taxation, mild regulations, low energy costs, and incremental progress in onshoring manufacturing activities. I'm pleased to say that Jose joins us now. Jose, good morning to you. Thanks for joining in studio.
Good morning, Danny. Always a pleasure to be here.
So I don't know, this sounds pretty positive. Have we basically done a round trip? Are we back to where at the start of this year, hoping for more deregulation and tax cuts?
Well, that's where U.S. investors are right now. You know, the biggest negative of the Trump policy mix happened to be trade. And with those agreements done with the UK and the break on China, there's a lot of optimism going forward that a lot more agreements are going to be getting done soon. So now the focus is shifting to the more positive aspects, the more traditional GOP playbook, which is lighter regulations, lower taxes, lower energy costs, and then onshoring manufacturing. That's going to be more of a slow-moving force, but we think that that's going to provide more earnings growth for corporate America in the years to come.
Can you completely write off the impact of tariffs, though, at this point? Because even if, let's say, the agreement lasts between the U.S. and China, where it's 30% is still higher than we were pre-Liberation Day.
Absolutely. And, you know, with China, there's going to be more of an adversarial posture on trade in terms of those tariff rates. And with Beijing, 30% is probably going to be one of the most highest rates. Other nations are probably going to be around 10, 15, 20. We saw during Trump 1.0 that the U.S. economy did fine having an adversarial posture on cross-border commerce against Beijing. We didn't have much inflation. Economic growth in some quarters was north of 4%. You know, so we think that as long we can maintain our rivalry with China as long as we get along with everyone else somewhat.
Well, there's this fear, and Dario Perkins of TS Lombard posting about this idea that if we had the extreme tariffs and a recession means disinflation. But he posited the question, if we get lesser tariffs and strong growth, does that equal inflation? But it sounds like you're less concerned about inflation if you're using the playbook from Trump 1.0. Is that fair?
That is fair. I am less concerned. You know, goods as a percentage of the economy every year continues to decline, and we have offsetting factors. You know, yesterday's numbers from PPI, what a bifurcation. Core goods accelerated at the fastest rate in 27 months. But the headline PPI dropped at the fastest rate in 60 months, back to April 2020, the depths of COVID. And that just goes to show you have the countering effects of services, food, and energy really blunting the goods cost. And the President Trump and the administration has known this from day one, and that's why they've been talking about drill, baby, drill, trying to really ramp up oil production, even though under the Biden administration we had terrific production numbers, but really that mantra has helped to keep oil prices subdued.
So is it a problem then, what we're hearing from Fed speakers? Raphael Bostic was on the Odd Lots podcast. They just released it this morning. I was just looking over some of the things he said. He called it a period of tremendous transition, that we have to push against inflation pressures from tariffs, and that uncertainty is unlikely to resolve itself quickly. This is a Fed that's still trying to defend against inflationary pressures. Do they have the wrong posture currently, given what you're talking about?
I think that they're a little too hawkish. I think they should be lighter. You know, the CPI is at 2.3%. The headline PC is somewhere around there as well. You're right near the 2% target. You know, we haven't seen that labor market weakness. As soon as you see that, however, I think they're going to turn so quickly like they did last year in, you know, you saw that June, July, weaker payroll numbers, September, bam, you got a double quarter, half a point hike, aggressive move downward. You know, our prediction markets expect that too. They expect few rate cuts into year end, about 3, also heightened economic growth. And since we've had this progress on trade, expecting lower recession risk.
So if it's lower recession risk, inflation isn't a problem. Could we get back to the world where we're talking about soft landing cuts again, that they're cutting because inflation looks more benign and rates are too restrictive given that? And the thing that had really juiced markets before, it kind of sounds like we might be heading down that path again, given what you're saying. You know, I think inflation is going to stay a little above target. I think we're going to stay around 2.5. We might get to 3, but I think we're going to stay below 3. I don't think that that's a bar where the Fed's going to come out and want to hike with the CPI, let's say at 2.8%, 2.9, 2.7, but it's still a very constructive environment for stocks. We saw in 2023
and 2024, these were years with high inflation, and stocks did great in excess of 20%. So if you have a little bit of higher inflation, that compounds over time quite rapidly, and you have a central bank that's not particularly apprehensive, then you can run higher in stocks despite these elevated valuations.
Did you make anything of Fed Chair Powell saying yesterday that they were reconsidering the language on average inflation targeting? So in other words, in COVID, they let it kind of move around 2%, but they were reconsidering that framework. Did you make anything of that?
Yeah, I mean, for a while now, especially since COVID and going back to the 2008 great financial crisis, there's been a move away from, for example, the CPI to the PC and trying to modernize inflation measuring and where the Fed should be. So, the monetary policy is constantly evolving, same as the economy. So, we got to be ready to hear and see what changes are coming through.
Well, we're going to get University of Michigan's survey, and that has really been brushed off as something that is political. But the Fed cares about you, Mitch. And Bank of America laying it out yesterday, also saying it doesn't really matter why it's moving, even if it is political, if inflation expectations are going higher, or if just general feelings about the economy are moving lower. It's something that the Fed has to pay attention to, even if it's driven by Democrats and independents, for example. How much value do you put in some of these survey measures?
A lot less recently. And for so long, these consumer sentiment and confidence figures have been a leading indicator of the economy. Once they've started to decline, consumer spending has dropped, and then we've got into a slowdown. But since COVID and with inflation, and it goes to your question earlier about how things have changed so dramatically, consumers see the stickers when they go out shopping, and that really moves inflation expectations in their mind. But we look at market-based inflation expectations in the Treasury market. There's a wider gap between what people think inflation is going to be and what fixed income investors actually think. And actually, interestingly enough, I was with one of your colleagues, Jonathan Levin, in Miami. We were actually talking about this discrepancy between where consumers think inflation is going to be and where the Treasury market implies it. Inflation expectations have been in the Treasury market have been increasing slightly, but not as much as those consumer expectations. And, final point here, consumer sentiment has been bad, but also the Conference Board's consumer confidence figures have also been bad. And I know on the street there's been varying opinions on which one is more political or not.
All right, Jose, really wonderful to have you in this morning. We're going to get that University of Michigan sentiment survey out at 10 a.m. Eastern. Please enjoy the rest of your Friday and your weekend. That is Jose Torres of Interactive Brokers. Let's get you some other top stories now that are trending on the terminal this morning. President Trump said that he would meet Russian President Vladimir Putin as soon as possible as he tries to facilitate a peace agreement in Ukraine. Trump had said he would consider attending an in-person meeting in Turkey this week between the Russian and Ukrainian leaders, but the meeting never materialized after Moscow sent a delegation of lower-level officials. The U.S. Treasury is warning Hong Kong banks against funding Iran oil trades. Bloomberg sources say a delegation from the Treasury made the warning last month. This month, the department sanctioned 9 non-bank entities in the city alleged to be involved in such trades. Now, elsewhere, Charter is said to be in talks to combine with its rival Cox Communications. Again, that is Charter said to be in talks to combine with its rival Cox Communications. Okay, coming up, hedge funds piling into cash and trimming tech. We're going to look at the latest 13F filings. That's coming up next on your Bloomberg Brief. You're watching Bloomberg Brief, and I'm Danny Berger in New York. Now, hedge funds have boosted positions in healthcare stocks in the first quarter while cutting exposure to tech. Some went even further. Michael Burry bought puts on Nvidia ahead of the start of President Trump's trade war with China and Liberation Day. Let's get through the details on the 13F filings. Joining us now is Bloomberg's Charlie Wells. Charlie, you've been digging through these filings. What have been your big takeaways?
I love 13F Day, and Bloomberg has been digging through 736 of these first quarter hedge fund filings, and it's been really striking to see what we've seen. So basically, the biggest ad of all of these hedge funds was Pfizer, which is a little surprising. You know, their share price has been down about 20% so far this year, and this could theoretically be maybe a bet on a recovery, right? They've been kind of slumping in that post-COVID period. It could also be a kind of positive sentiment around their pipeline. They've been really trying to get into that obesity drug space. We know they had a fail on a pill they were trying to develop, but there's a chance that maybe there's a little bit of M&A on that front. So that was the biggest ad. One of the biggest cuts, interestingly, was AT&T. And now we know AT&T, their share price is up about 15% this year. They've been aggressively trying to add market share, trying to add customers. This could potentially maybe be a view that, you know, there's not a lot of room to run. And then, of course, we know in that first quarter, there was that significant hit to tech, and we saw trims on NVIDIA and Uber as well.
It's always a little bit tricky because these are somewhat backward looking, but even so, everyone wants to know what the big players did. Burry and Berkshire Hathaway made some headlines, Charlie. What are they doing?
Bearish moves here. And so Michael Burry's Cyan Asset Management, they bought puts on NVIDIA and also some Chinese stocks. So that shows a little bit of bearishness there. But also, Cyan Asset Management liquidated its entire listed equity portfolio as well. So again, bearishness on that front. And if you look at Warren Buffett's Berkshire Hathaway, they made no significant ads. So that's a little bit striking as far as what they didn't do. But everyone always pays attention to Berkshire and Apple, and they made no change to that Apple front. So that's striking too, because that is their largest holding, and it's closely watched.
All right, Charlie, thank you very much. That is Bloomberg's Charlie Wells. By the way, I just want to bring you some breaking news over EU fines on antitrust and Microsoft. It does appear that Microsoft is on track to dodge EU antitrust fines in its Team Probe. Microsoft apparently is going to be offering unbundled Teams, and that's going to be tested by the EU, market tested rather. Positive feedback could pave the way for the EU settlement without fines. So this is the European Commission saying on Friday it's starting a so-called market test of Microsoft's proposal to sell Teams separately, allowing them to dodge a hefty fine if the EU does improve. Let's get more on a different tech stock that we are watching this morning. Coinbase has disclosed a hack that is expected to cost the crypto exchange $400 million. Hackers gained access to customer data that includes names, date of birth, addresses, and government-issued ID numbers. Shares are rebounding. You could see there in the pre-market after dropping yesterday on the news in the last session. Joining us for more is Bloomberg's Tom McKenzie. And Tom, $400 million of a loss, that's not really that much. It's a drop in the bucket compared to some other hacks. But why is this notable for Coinbase?
Yeah, look, 400 million, as you say, is not insignificant as a number, but compared to previous hacks, we had about $2.2 billion in terms of crypto-related hacks just in 2024 in total. It isn't a huge number, but it's the impact in terms of the brand around Coinbase, which, as you know, Danny, has been that poster child in terms of pushing crypto into the mainstream, being the first publicly listed crypto exchange, of course, lobbying to get crypto-friendly lawmakers into Washington, D.C., into positions of power. Recently added, of course, to the S&P 500 as well in the last 3 days. And also, and this is crucial, the custodian of $122 billion US, almost the entirety of that, the custodian of much of that is held and looked after by Coinbase as part of their prime offering for those ETF exchanges, for those institutional investors. Now, none of that was affected. That was not impacted. The prime part of the unit and the business was not impacted by this hack. But details were passed on to these hackers, were gained by these hackers, as you say, from their customers, including at least one high-profile, high-net-worth individual that Bloomberg is not naming. And essentially what they were doing, these hackers, was bribing customer representatives in India to pass on information, again, including IDs, including names, addresses, and then trying to use that, the hackers, trying to use that to pressure and trying to get access to other financial institutions, to try and get access to their banks and their details. Coinbase is saying they're going to be reimbursing any customers affected, and they're also offering a $20 million bounty that would lead to the arrest and detention of these hackers. They're reimbursing their customers, but clearly this is a big dent to the reputation of Coinbase.
Tom, to that point, because you talked about how at the start of this year there was so much enthusiasm for crypto for companies like Coinbase spending on lobbying. There was even a New York Times story yesterday pushing back against maybe some of those efforts, with the SEC apparently investigating whether they misstated their user numbers. Just how different of an environment is this for the Coinbases of the world, for crypto in general, versus where we thought we would be at this time when we had the election of Donald Trump?
Yeah, that's a really interesting question, because you had those changes at the top of the Securities Exchange Commission, of course, as the crypto lobby had pushed for, as the crypto industry had lobbied for. Those changes have been put in place, so it's a more crypto-friendly environment. Of course, President Trump has done his bit as well to tout the crypto industry and making certain moves there to try and support the industry and make the US that home, that global hub of the crypto industry. So those changes are real, and we can expect those to continue. And of course, Bitcoin itself is still at around that $100,000 level, so a level that many skeptics would have poured scorn on just a few months ago. That's where we are in terms of the price gains coming through. But the anonymity of those users, the fact that this is all done, of course, on the blockchain, that has always created a problem in terms of how they deal with hacking and how they deal with cyber risks. And Coinbase is just the latest reminder. Again, $2.2 billion last year in total, according to some analysis.
Tom, thank you so much for your excellent reporting. That is Bloomberg's Tom McKenzie. Now, elsewhere, Richemont shares rising in the European trading session. That's after the Swiss luxury group posted a jump in full-year sales thanks to its popular Cartier brand. Here to unpack the quarter for luxury and retail is Bloomberg opinion columnist Andrea Felstead. Andrea, I got to say, I'm surprised that some of this is still doing so well. I thought that the love bracelets were overdone, that Van Cleef, there are too many fakes out there to really be popular. What do you make of the really strong set of results from Richemont?
That's definitely a risk, but so far the jewellery is still selling well. Cartier has enjoyed a real boom, not just in jewellery, but in watches too. That's helped, but I think there is definitely a risk of overexposure.
Is all luxury created equally right now, Andrea? Because I was looking at the share prices earlier. Richemont has had a great year, up 20%. LVMH is down nearly 20%. What distinguishes the difference between what luxury is thriving and what is not in this current environment?
It depends on your brand. If you've got a strong brand, as we mentioned, Cartier and Van Cleef, and it helps what sector you're in. Jewellery has been really strong over the past year, partly because it hasn't raised prices as much as handbags. So jewellery looks a better value than a handbag. And also, when we think about LVMH, we think about Louis Vuitton, Dior, all of its fashion and leather goods brands, but it's also exposed to drinks through Moet Hennessy, and drinks are really having a tough time at the moment.
Well, having a tough time, speaking of having a tough time, U.S. retailers, Andrea, if that's one end, luxury, you have Walmart on the other end, who yesterday warned that they're not going to be able to absorb price hikes due to tariffs forever, that at some point they're going to have to pass that on to the consumer. Is there a real risk at this moment that retailers that Walmart almost kind of gives them the clear, that they're all going to be able to start to rise prices if one of the biggest retailers in the U.S. is beginning to do that?
Definitely. Walmart is probably best placed of anybody to deal with tariffs. It's huge, so it's got great clout with suppliers. It's also traditionally very cost conscious. It controls its own costs, and giving good value to customers is in its DNA. So if Walmart is saying it's got to pass these on, it's going to be 10 times more difficult for everybody else.
Andrea, thank you so much for joining us this morning. That is Bloomberg opinion columnist Andrea Felstead. Coming up, we're going to wrap up your week with more economic data on deck. We'll have your trading diary for you next on your Bloomberg Brief. Let's get you set up for your trading day on this Friday. U.S. housing starts. That will come in at 8:30 a.m. Eastern time. Then we'll have the latest University of Michigan sentiment survey that comes out at 10 a.m. And then some Fed speak. San Francisco Fed President Mary Daly will be speaking at 9:30 p.m. Now, some individual movers in the pre-market. Applied Materials extending post-earnings decline, giving a tepid forecast. Chinese sales slipping. Vistra, those shares up 5 1/3%, agreeing to buy 7 natural gas-fired power plants for nearly $2 billion to feed the growing demand for electricity from AI. And Estee Lauder up more than 5% after filings from Michael Burry's Scion showed that it doubled its position in the stock market. Just want to flag the most recent note from Bank of America's Michael Hartnett coming out this morning saying that EM is in the beginnings of a major bull market and it will be the best performing thing this year, saying that a softer dollar and a recovery from China will be fueling emerging markets. All right, that is it for your Bloomberg Brief on this Friday. Surveillance is ahead.